Welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial investment and retirement future. What to do with your money, what you should be paying attention to, what opportunities we have available to us. We'll talk about all of them on today's program. He is president and founder of McIntire Retirement Services, your resource, ladies and gentlemen, for that guidance. Chris McIntire here with us. We always appreciate the time. Chris, how are things going there at McIntire Retirement Services these days?
Hey, good morning, buddy. Hey, we're doing real good, keeping busy as always. And, we're going to start with our tip of the week here. And, we're going to bring up the topic of de-risking. Okay? De-risking is not abandoning opportunity. Rather, it is about analyzing and recognizing opportunity.
Yeah, well, I think, Chris, that intuitively, we sort of think that we should not de-risk because we're going to give up some of our money's opportunity for growth. You're saying that that's actually not really the case.
Oh, actually, it is the exact opposite, Peter. And again, when you hear that word de-risk, yep, your mind might go right to, oh, well, heck, I'm not going to put my stock portfolio in a money market account, for example. That's what most people do. They go to that kind of rationale. I think it would be more along the lines of, let's kind of look back at the end of 2025, for example, and all of a sudden, all those growth stocks that had been driving the market so much, Nvidia, Facebook, the Magnificent Seven, were falling out of favor, and your value and dividend stocks had a remarkable rally there in the last 2 months of the year. So that would be about de-risking, where you're not so concentrated in one particular sector, as an example.
Yeah, and Chris, I think that your statement about moving to money market is what a lot of people think about, swinging the pendulum all the way to the other end of the spectrum and basically putting your money in a place where instead of growth opportunity, it's kind of just gathering dust and interest only. But you're talking about rebalancing and rotation and capturing gains when they're available. And your example there of the Magnificent Seven in 2025, I believe, if I recall correctly, is reminiscent of the dot-com bubble back in the late 1990s as well, when there was so much concentration in the tech sector that had that similar kind of rotation, where if people had been spread out across different sectors, they would not have felt nearly the downtrend that the market as a whole had. If I recall correctly, it was the concentration that had people losing more than maybe they were comfortable with.
Yes, yeah, you're exactly right, Peter. And then, we could say 2007, 2008 would have been the housing sector of the economy. If you weren't invested in real estate investment trusts or REITs, for example, and you had money in other places. And, again, when we talk about de-risking a portfolio of somebody who's getting ready to retire, they certainly are interested in de-risking from, a 100% stock portfolio, for example. So, we de-risk by, using asset allocation, income allocation, as our buddy Dave Gaylor would say, and we have no problem whatsoever with de-risking a portfolio by including a safe money strategy. But, there are a lot of other de-risking pieces as well, right? There's legislation that we have to de-risk from, those required minimum distributions. Should you be doing Roth conversions ahead of that in case they increase those required minimum distributions, as an example?
Yeah, well, de-risking, Chris, we'll talk about it on today's program, but it is about alignment, not exiting. It is about intention, not fear, ladies and gentlemen. This is intentional with the moves that we're making, not from a fear-based reaction emotion. So we'll talk about these strategies to help you understand when, how, and what options you have when de-risking your portfolio here on the program, Your Game Plan for Retirement. And as always, great information coming your way. Don't go anywhere, but the true value of the program. Chris McIntire, founder of McIntire Retirement Services, does make the offer, extend to you the opportunity to get your game plan for retirement put together. So if you have questions about anything on a financial investment or planning nature, give a call, start the conversation. It is a complimentary courtesy service that they offer there at McIntire Retirement Services. 419-332-0532, the number to call, 419-332-0532, 419-332-0532, or you can visit online, McIntyreRetirementServices.com, McIntyreRetirementServices.com. And I appreciate the comment, Chris, that there are several different types of risks that we are exposed to. I think our mind, when we say financial risk, kind of automatically goes to the market. But as you point out there are many other types of risks that we'll be addressing on the program. So backing up 30,000-foot view, what does de-risking our portfolio actually mean to you for providing context to this conversation?
Yeah, so let's set the parameters here, and let's say we're dealing with somebody who might be, in the mid 60s, have retired, they've transitioned into Medicare, and maybe they de-risked their lifestyle by working until age 65 and then transitioned on to Medicare so they didn't have to privately pay their health insurance. Okay. And then they end up, they have a 401k. They want to know when should we take Social Security. So we, try to help de-risk that longevity, right? Running out of money, de-risk, that side of it. And then look at the portfolio itself from the individual investments that are in there, and do we need to generate income? And if we do, then we can utilize all those income producing dividend stocks, bonds, annuities, structured notes, things that are more focused not necessarily on growth, but not to remove growth, but just to minimize some of that downward, the 30% corrections in the stock market that can derail a portfolio. So, sometimes we will certainly, take some of the heat out of the portfolio if it's overly concentrated, and you talk with the clients and understand what is their risk tolerance. Do we have a safe money strategy in play where, if the market falls, if we have to, that we can de-risk the withdrawals that they're taking out of the portfolio and shift them to another strategy that we would have employed.
And Chris, we're not trying to time the market, but timing for de-risking does matter. It's more about our progress, our lifespan, our time horizon on things for when we should be considering these moves to de-risk the portfolio, it sounds like.
Yeah, absolutely. And we'll use 2022 as an example. That was kind of our last real significant, a little bit of a longer term downturn in the marketplace when they were raising the interest rates. And, if you are still working right now, that was a great buying opportunity because you are in the growth phase of money. So put money into work for yourself while the market dips through those 401k or IRA contributions you're doing. On the other side of it, if you were pulling income out of your stock and bond portfolio, boy, that took a hit, and I remember having conversations with clients, obviously, to say, look, at some point they'll stop raising the interest rates and these prices will recover, but we're just paying you out the dividends and the interest anyway. We're not necessarily having to sell investments to create that income. And that's the difference between income producing instruments versus, just something that's just only going to grow like a stock that doesn't pay a dividend. The only way to make money on that is for that stock price to increase. So, de-risking a portfolio may mean shifting from more growth stocks to more income producing stocks like utility companies and, energy companies and by and large.
Yeah, if your time horizon is limited, Chris, your ability to course correct and get back on track, your time horizon, if it's extended, we've got plenty of time to do that. But if your recovery time is limited, not enough time to recover and course correct, then that's probably a cue that we should be de-risking or it is time to start considering de-risking. Losses can be more impactful. You've talked about like the red zone, right? We're here on your game plan for retirement, so it's a thematic term here. But the red zone, 5 to 10 years before retirement, 5 to 10 years after retirement, these are critical times, and we don't have the time horizon that we once had.
Yeah, you're absolutely right. So, things that we would be doing would be rebalancing the portfolio, increasing the fixed income options, reducing the concentration risk so that we're not all, heavily invested in the tech sector, for example, and then making sure that there's enough emergency money available for, if you have to build, put a roof on the house and, some of those big ticket items. But we also want to make sure that we're de-risking the tax liabilities as well, because the bulk of people's money today is in those 401k accounts while they're working, or 403bs, if you will, and then transitioning them into IRAs and looking at different types of asset classes that we can utilize to help the clients achieve their goals and live a nice, comfortable type of retirement, give them some peace of mind.
Yeah, I think we're going to dive into de-tax risking, de-legislative risking here, Chris, because I know that you in particular appreciate that self-proclaimed tax nerd that you are, and that you help a lot of clients understand the risk that we have from a tax perspective. But I do want to circle back to the liquidity that you mentioned there, because we do need liquidity, right? And we want a reserve that is accessible and liquid to us. But I hear a strategy often floated when talking about de-risking, that I'm going to keep several years worth of expenses in cash. We talked at the beginning of the program that we didn't want to swing the pendulum all the way to the other end of the spectrum and just sit money in cash, essentially doing nothing. So evaluate that strategy with us. Does it make sense to have that much money liquid? Are we going to need that kind of reserve, or where do you put that threshold for planning with your clients?
Yeah, yeah, great question there, Peter. And a conversation we have quite often. And, I was having a meeting yesterday with some clients recently retired. They are not 65 yet, and they have to pay for their own health insurance. So they have a large sum of money in an emergency account, just basically savings, that they can draw on to keep their income down low. So they're doing it intentionally.
Okay.
They have, significant dollars at risk in the stock market, and, but they got to get to age 65. So let's say today somebody is already 65, made that transition. They're nervous about the stock market. And I've got a client that says, look, I'm never going to be rich, but I want to guarantee that I'm also never going to be poor, and wants to stay very, very conservative, and probably giving up a lot of long-term opportunities just given their age. But that's what they're okay with. The stock market can, drive you crazy at times, no doubt about it. But if you have an overall risk profile that, look, I'm still pretty conservative, that means you can still have a little bit in the game,
Yeah.
but you're looking more on the bond fixed income side and the safe strategy. But, you're losing so much opportunity sitting in cash, doing nothing. And, when inflation is 4 or 5% in the real world, right, with the price of gas at $6 a gallon or whatever it is where you live, you at least need to continue to make so you're not losing your purchasing power, because when you walk in there to put that money in a CD or a bank account and to do nothing but provide peace of mind, you should have to sign a waiver that says, I understand I am losing purchasing power by doing this with a significant portion of your life savings. I mean, you and I both have our emergency fund. We're not discounting that. We all need to have that emergency fund, but probably not 2 years worth of income. And I think Dave Ramsey, who we talk about here on the show a lot, and Susie Orman, some of those more popular talking heads that people are used to hearing and seeing, they would say, maybe 6 months is fine.
Right. Right.
Yep.
Yeah. Yeah. Three to 6 months, I think, is kind of the accepted amount to have in bank style savings emergency account. But again, some people are talking about 3 to 6 years worth of cash just in case there's a market crash. And I get that, but we want the cash portion of our plan to be intentional, not fear-based. And your first example where they were healthcare planning with some cash, that makes sense. That's part of the context of their planning. But just to have years worth of income sitting around doing nothing, earning next to nothing, not keeping up with inflation, oftentimes that is a result more of fear-based hoarding of cash and assets. And we don't want to do that, but we do have alternatives, right? So, Chris, what are some of the things that people can de-risk into? I mean, I know cash is one of them, but we've already talked about maybe having a limited amount of cash. So what are some of the other alternatives? You've mentioned a few, I think, but sum it
Yeah,
up.
sure, Peter. Yeah, and outside of your traditional banking instruments that we've been talking about here, CDs and savings accounts, you've got the fixed income elements of bonds, so you can buy a bond ladder just like you can with a CD ladder, and depending on, how much interest you're looking to generate, then you can look at what type of bonds should you buy: municipal bonds, government bonds, corporate bonds, high yield bonds, something that has a maturity date that says, okay, if everything's okay on the maturity date, you get your money back. We use structured notes a lot in our practice, and that's a 1 year bond structured around stock market indices that, can offer a degree of downside protection and an above average interest rate, right? And, those are a unique instrument that we don't have time enough on the show to go into all the great details, but a great income generator. You have, the annuity side of things. And in our practice, we use, typically the fixed annuity or the fixed index annuity. We're not a big variable annuity fan, some hidden costs and things, not necessarily hidden costs, but, additional costs that we don't necessarily buy into. So fixed annuity kind of compares against the CDs backed by an insurance company, pays a guaranteed interest rate. Right now, we're getting pretty solid rates of, in that 5% range for a 2 to 3 year fixed annuity. That's not a bad interest rate, tax deferred too if it's outside IRA money. The index annuity links your performance to a stock market index and offers principal protection when the market goes down. So, we have a lot of clients that say, look, I don't mind playing the market. I just like to have some defense in place. So those are some instruments. And then we use our buffer strategies as well that offer some downside protection in various degrees on the movements of the S&P 500, for example.
Every strategy does have some trade-offs, though. Every vehicle has strengths and weakness. So stability does sometimes reduce some upside potential in one area, Chris, but the right mix of assets is going to give us that strength and stability that we're looking for, and how you mix it depends on your goal. And as you have talked about often for your clients, a lot of times the goal is to have safe, dependable, reliable income that they can spend 1 month and know is going to be replenished the next month. And so income planning is actually a large part of de-risking a portfolio.
Yes, yep, without a doubt. And, something that's a pretty big piece of what our practice is. Obviously, we deal in that retiree market by and large. And, we like to de-risk portfolios before they retire, right? We want to, income plan or get the investment plan in place ahead of somebody retiring so that, and that often involves some portfolio, shifting and management, to a little more of a defensive strategy, not taking away some of the growth. Obviously, if somebody's 65 years old and their parents all live to be in their mid 90s, they need to have the potential for longer term growth to even outpace inflation, and make real money. And obviously, as you get older, you typically can get more conservative. However, you could make an argument that, well, look, I'm in my mid 80s. I'm not spending what I used to. Why am I being so conservative? I'm going to end up passing this money on. Do we step it up a notch? And it was my great uncle Howard. That's what he said. I'm not spending any more of this. So, let's stay in stocks. I remember him saying, and I was just a kid. He's been passed away for a long time. Yeah.
Well, Chris, I got the question recently, why has income planning become such a buzzword? Why is that? Why are we hearing so much about it? And I said, well, there's a generational demographic wave here who is moving out of their careers and into retirement. And when you have an income, you need an investment plan. But when you have investments and there is no income, you need an income plan. And so, right when the income paycheck goes away, that's when the income planning becomes absolutely critical and crucial.
Yeah, without a doubt. I had a client coming in yesterday and 62 years old, getting ready to retire here. And he's lucky he's got some legacy health insurance that he gets to take with him and his wife. So, they don't have to go out of pocket for a lot. But, now we have to replace some of that income that he had been earning. He can take his Social Security at 62. And I think we're going to try and wait a number of years just so he can get a bigger benefit down the road because if we take it at 62, that's the least amount he's going to get for the rest of his life. And even if we just wait until age 65, he's going to get a much bigger payout. And then if something happens to him, that would go to his spouse as well. So then we will look at shifting some of the growth investments into income now that I think he's made the decision to pull the plug and start enjoying, I'll say enjoying life. They have aging parents as well. So I think they're just changing one job they get paid to for another one they're doing out of an act of love and compassion for parents like all of us are right now.
Yeah, Chris, I think a lot of us are in that situation or looking at that into the future where we are helping care for parents and what all that means for not only our life and activities, but financially as well in some cases. So that might be something, a conversation that you hold with people about de-risking. How are we planning to care for parents and care for ourselves so we're not placing a burden on our children down the road. But I do want to, for the sake of time here, Chris, move into something that you've touched on here, which is de-risking from a tax perspective. And I know that this is one of the biggest and maybe most overlooked opportunities to de-risk. Can you talk about de-risking from a tax planning perspective with us?
Sure. Sure. And most people have the perspective as through their working years is, to try to keep their taxes as low as possible. And they go into the retirement with that. And, typically when you go into retirement, your income's a little bit lower, right? If you were earning $150,000 a year, in most cases in Midwestern states here, people don't necessarily retire with $150,000 of income. And so, their tax base is lower, so we can de-risk their tax liabilities by looking at Roth conversions, and we are in a very favorable tax environment right now. Roth IRAs do not have required minimum distributions. You can use the same investments in your Roth IRA as you have in your traditional IRA, and in fact, if the market falls by 20%, then you can move that, and I'll just use NVIDIA stock as an example. Move that NVIDIA stock from your IRA account into your Roth and then let it recover ideally and come out on so you paid less tax on the NVIDIA stock, and then when it recovers, you get all that good growth. That's an example of a Roth conversion strategy there. When the market drops, look for the opportunity to de-risk your tax liability.
And Chris, most people can tell you within a pretty slim margin of error how much they have in their tax deferred retirement accounts. But very few people have ever looked at, have ever quantified or calculated out how much they will pay in taxes on the balance of that account. That's something that you can show people, you can work through, you can calculate with them, and you can also show them the savings, quantify how these strategies will benefit them as far as tax control and reduction.
Yes, absolutely. The tax return is a key component when we meet with clients and prospective clients to understand what is their tax base. Where's the income coming from? Is it just wages? Is it IRA withdrawals? Is it pensions? Is it Social Security? Is it dividends that you have outside of IRA accounts? Let's look and see what the story is here and where can we start de-risking this tax liability that they may have and make it nice and efficient. And I will say this, delaying taxes is not a plan.
Mm.
It is an inevitability. Controlling that tax liability, that's a plan. But just by the fact of, look, I don't want to do anything whatsoever because that'll cause me to pay tax. That would not be my strongest point perspective right there.
And people are surprised by how much tax they have to pay when they make an IRA withdrawal, Chris. I mean, some people kind of forget completely that taxes have not been paid on that balance. And a lot of times we very much underestimate what that tax bill is going to be.
Yeah, we deal with folks, later on in the year, they say, "Hey, I need to pull out an extra 25,000 to do this, that, or the other thing." And I'm like, "All right, well, that put you in the 22% tax bracket with this money. Previously, you were in the 12. Can you wait until next year, or can we split this in half and do some in November and some in January to spread it across 2 tax years as an example on how to de-risk that liability?"
Yeah. Well, again, we are talking with Chris McIntire, ladies and gentlemen. Questions, concerns, or if you would like to get your game plan for retirement put together, give a call, start a conversation, 419-332-0532, 419-332-0532. Now, Chris, you have a list here, bullet points of key times to transition. When is the right time to de-risk? And while there's no single age or magic moment, I do notice that none of these even mention the market, which is kind of critical to consider and think about.
Yeah, and I would say, if when you want to look at the de-risk in some of the market, do it after you've had a good year for sure, right? Shift some of those dollars, but you also want to do it 5 to 10 years in that retirement window, start de-risking. When you retire itself, major life changes, health considerations, dealing with a mom in a nursing home, those are, you need to de-risk some of that health care liability, if you will, and look at what options there. So there are lots of different things in life that you're going to have to de-risk, thinking about the loss of a loved one prematurely, and that happens, unfortunately.
Indeed, of course. But de-risking proactively, not reactively, planning creates the opportunity and to look ahead. That is when we are de-risking. Again, this is not removing opportunity. It is identifying opportunity and realizing it, ladies and gentlemen. So the big takeaway here, de-risking is about resilience and it's about opportunity. And every investor eventually reaches a point where the conversation shifts from how much can I grow to how much risk do I really need to take? And Chris, I know that is a big part of the conversation there at McIntire Retirement Services, helping people quantify their comfort level and their need and necessity for risk, and then making sure that their portfolio is aligned with that risk, identifying opportunities, protecting what's important, kind of the mission there at McIntire Retirement Services.
Yeah, absolutely, Peter. Something that we take a lot of pride in. We've got great staff, we've got great support, and we love to help people de-risk things in their lives.
Well, once again, ladies and gentlemen, if you've got questions, concerns, if you would like to get your game plan for retirement put together, a personalized plan with your goals in mind, long-term and diversified strategies to help you achieve and accomplish them, pick up the phone, get the conversation started. It is a complimentary service to put together your game plan for retirement there at McIntire Retirement Services. 419-332-0532, 419-332-0532, 419-332-0532, or online at McIntireRetirementServices.com. McIntireRetirementServices.com. With Chris McIntire, your resource. So many have taken advantage of this offer, but so many more need to get that plan in place. Make sure that they have covered all of the bases and the pillars foundationally for long-term lasting stability from a financial perspective. Get your game plan for retirement put together. Give Chris McIntire and the team at McIntire Retirement Services a call. 419-332-0532. Chris, always a pleasure. Thank you for a great conversation today.
Hey, good to be with you, buddy. Thanks, everybody, for listening, and may God bless America.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Investment in notes involves risks not associated with investment in ordinary debt securities. The securities are not bank deposits and are not insured by the FDIC or any other government agency, nor are they obligations of or guaranteed by a bank. The securities will not be listed on any securities exchange, and there may be little or no secondary market for these securities, and secondary trading may be limited. Accordingly, you should be willing to hold your note security to maturity. These securities are subject to the credit risk of the issuing bank, and any actual or anticipated changes to its credit ratings or credit spreads may adversely affect the market value of the securities.